Welcome back to the ComLucro channel. In this video, you will learn a market structure trading strategy built on smart money concepts combined with Fibonacci to identify high probability entries, targets, and risk levels with precision. This is not theory or guesswork. It is a structured, rule-based approach designed to help you understand buyer and seller psychology, identify valid break of structure and change of character, and use Fibonacci only after direction is confirmed, so you can trade with clarity instead of emotion. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now, let's get started with the market structure. The behavior of market movements can fundamentally be attributed to two main factors that consistently dictate the direction of prices: trends, which encompass both uptrends and downtrends, and the consolidation phase, characterized by choppy or ranging markets. Picture this as a perpetual cycle, where prices continuously oscillate between downtrends, uptrends, and consolidation periods, each gathering liquidity and institutional orders. Typically, prices need to consolidate following uptrends and downtrends. A vital initial step when analyzing your charts is determining whether the market is currently experiencing an uptrend, a downtrend, or is in a consolidation phase. To build a robust understanding, let's start with a straightforward overview of market structures before exploring the intricate details of advanced market dynamics. Consider an idealized version of a market structure reflecting a perfect uptrend. I term this as ideal because it's rare to encounter an uptrend in real markets that follows this pattern precisely. Markets don't usually move with such predictability. Nevertheless, to enhance our understanding of uptrends, let's examine this ideal model before shifting our focus to the more realistic uptrend structures that are more commonly observed. In a typical uptrend, prices will consistently create higher highs and higher lows. The pattern generally sees prices surpassing previous highs while sustaining the lows. An uptrend concludes when there is a break below one of the significant lows. To preserve the continuity of an uptrend, it's essential that these major lows remain unbroken. Additionally, when a price exceeds a major high, it results in a structural break and forms a demand zone, indicative of a break of structure, or BOS. Accurately identifying major highs and lows is crucial because it allows us to recognize signals for potential trend reversals or continuations. Without correctly pinpointing these key points, traders are at risk of misinterpreting market signals and potentially entering trades on the wrong side of the market. These principles are equally applicable in bearish scenarios. During downtrends, prices consistently form a sequence of lower lows and lower highs. In such scenarios, prices tend to break below previous lows while still respecting the previous highs. Let's explore the details of a realistic market structure, focusing on the more commonly observed uptrend patterns in the market. Consider a scenario where the price surpasses previous highs, breaking upward. At this juncture, a key question emerges. How do we pinpoint valid major highs and lows? To address this, let's examine the left side of the market structure. It is evident that the price underwent an upward trajectory until it began to retrace. The peak reached before this retracement is deemed the major high. Conversely, the lowest point during the bullish wave that triggered this upward movement and led to a break of structure and a new high is recognized as the major low. These 2 points are the critical external structures of the market, and any structure that develops between them is considered an internal structure. When the price surpasses the major high, marking a break of structure, BOS, it indicates a continuation of the upward trend. On the other hand, if the price drops below the major low, this should be interpreted as a signal of a trend reversal. The internal price actions within these external structures are secondary, provided the price stays above the most recent major low. Maintaining this condition signals that the market remains in a bullish phase. You might wonder why this low at the extreme is treated as the major low. The reason is that it represents the ultimate low point before the price starts its upward trajectory. This particular point is essential as it's the pivotal low that catalyzed the upward movement and the subsequent break of structure. Now, let's transition to the bearish scenario, which mirrors the bullish scenario. The bearish wave begins, leading to a structural break. We also identify a major low, marking the lowest point reached after the structural break. These 2 points, a major high and low, act as our external structures, while all structures developed between them are viewed as internal. Should the price break these major lows downward, it signals a continuation of the trend as illustrated here. Conversely, if the price climbs above the major high, this would be indicative of a potential trend reversal. In simpler terms, the internal price actions within these external boundaries are secondary, as long as the price remains below the most recent major high, signaling a bearish market. As the price retraces upward, it establishes a series of internal highs and lows within our defined trading range, yet it eventually ascends, breaking the recent major low downward. This internal high, situated at the extreme, is now recognized as the new major high because it marks the highest point reached before the price initiated a strong bearish push, resulting in another structural break. Following this, the price undergoes another retracement, forming another major low. After establishing various internal structures, the price sustains its downward momentum, creating a sequence of lower lows and lower highs. Now, let's explore another vital concept in market structure analysis, the break of structure, BOS. You might have come across this term in various trading tutorials, market structure videos, and handbooks. Typically, in a bullish scenario, a BOS is often simply described as a situation where the price surpasses a previous high. However, to accurately utilize this concept, specific criteria and rules need to be adhered to in order to confirm a valid break of structure. Let's dive into these key points and rules. A valid break of structure is confirmed when the price not only breaks, but also closes above the most recent higher high with the candle's body. This validation holds even if the price retraces downwards immediately after the break. In such instances, the market establishes a new major high and major low, defining a new trading range. Should the price then break this newly established major low heading downwards, it suggests a potential trend reversal, indicating a shift from a bullish to a bearish stance, a change of character, or CHOCH. Continuing our exploration, if the price breaks the previous higher high with a long wick or shadow, and the body of the candle closes below the high's range, and if the subsequent candle's wick does not exceed the first candle's wick, this does not qualify as a valid break of structure. In this instance, the resulting low is treated as an internal structure within the trading range. For a reliable indication of a trend reversal or a valid change of character, we need to observe the price breaking below the significant low at the extreme, rather than merely breaking above an internal high. Now let's consider a different scenario. If the price surpasses the recent higher high with a wick, and the body of the first candle closes below the high's range, but the subsequent candle's wick exceeds the first candle's wick, we then recognize this as a valid bullish break of structure. Here, a new major high and a new major low are established, outlining our updated trading range. The internal price action within this defined range is less significant, provided the price remains above our newly established major low, which signifies a bullish market. If the price later breaks this newly formed low downward, it then acts as a clear indicator of a trend reversal or a valid change of character. Transitioning to the bearish scenario, which mirrors the bullish one. For a bearish market structure to confirm a valid break of structure, the price must break and close below the most recent lower low with the candle's body. If the price breaks the newly created major high upwards, this signals a trend reversal, suggesting that control has shifted from sellers to buyers. Conversely, if the price breaks the recent lower low with a long shadow or wick and the candle's body closes above its range without the subsequent candle's shadow exceeding the first candle's wick, this is not considered a valid break of structure. To confirm a genuine break of structure, the price must close below the low's range with the candle's body. Moreover, if the subsequent candle's wick surpasses the first candle's wick and closes above the low's range, this then qualifies as a valid break of structure. We must also update our major low and major high accordingly. As long as the price stays below our newly established major high, the market is considered bearish. Only if the price breaks this new high upward do we acknowledge it as a valid signal for a trend reversal or a major change in character. Having explored various types and scenarios of break of structure patterns, and now possessing a solid understanding of what constitutes a valid BOS, let's delve into another key aspect of market structure mapping, the change of character, or CHOCH. The first step in identifying a valid change of character involves determining the general market direction, whether it's an uptrend or downtrend. Next, you need to highlight the valid breaks of structure on your price chart. In the bullish scenario, consider how the price forms a series of valid breaks of structure. The low and high that define these breaks are our major structures associated with the first valid bullish BOS. As previously noted, any price action that occurs between these two structures is deemed internal. Change of character patterns can be categorized into two types, minor and major. For instance, each time the price breaks any internal low, it signals a minor change of character. It's crucial to understand that a minor change of character alone should not be taken as an indication of a complete market structure shift. Here, we encounter a common pitfall in the market. Many novice traders who have not properly identified the market structure often misinterpret a minor change of character as a signal for a reversal in market direction. Believing that the bullish phase has ended, they might think it's an ideal time to enter a short position. Typically, they place their stop loss just above the internal high. However, contrary to their expectations, after a brief retracement, the price climbs again and continues its upward trajectory. This often results in hitting the stop loss of traders who took short positions. They frequently fail to understand why their stop loss was triggered by the price and tend to repeat this mistake. What they miss is a crucial detail. The price did not break the major low that would confirm a shift in market structure. They should not enter a short position until the price breaks the last major low to the downside. Their perceived change of character was invalid, and the price was merely in its retracement phase before resuming its primary upward direction. To capture a valid market structure shift signal, traders should patiently wait for the price to establish a major change of character by breaking and closing below the last major low that initiated the upward movement leading to the bullish break of structure. Furthermore, it's essential to remember that in a bullish scenario, a change of character pattern is only considered valid if the price breaks and closes below the last major low using the body of the candle. If the price breaks the most recent high with a long wick or shadow and then closes within the high's range, the change of character is deemed invalid and cannot be seen as a decisive market structure shift. This principle is mirrored in bearish scenarios. For a change of character to be considered valid and highly probable, the price must break and close above the recent major high with the candle's body. Any penetration merely by a shadow or wick is regarded as insufficient. Now that we clearly understand what defines a valid market structure, a confirmed break of structure, and a true change of character, we have the context we need to move from analysis into execution. Market structure tells us direction and bias, but it does not define precise entry, stop, and target levels. That is exactly where Fibonacci becomes useful. Fibonacci is not a standalone strategy. It is a tool we apply only after structure has already confirmed a valid directional shift. Now, let's jump right into this strategy and discover how to enhance your trading results with clarity and confidence. Let's start with the Fibonacci retracement. Open your chart on TradingView and select the retracement tool. For bullish moves, connect the low to the high, ensuring that 100% is at the starting point and 0% is at the end. For bearish moves, reverse the process, placing 100% at the top and 0% at the bottom. Once the retracement is drawn, open the settings to customize the tool for a cleaner and more effective analysis. First, extend the lines to the right so they remain visible as the chart develops. Then, uncheck all unnecessary levels, leaving only the essential ones: 38.2%, 50%, and 61.8%. These are your key retracement zones. Turn off the background shading to declutter the chart and disable the display of price values to maintain focus. Lastly, make sure the levels are displayed as percentages by selecting percent under the level section. This setup simplifies your chart, emphasizing the most critical areas for retracement analysis. Next, let's dive into setting up your Fibonacci extension tool for precise and effective analysis in TradingView. To set them up, select the Fibonacci extension tool and mark the 3 points: the start of the move, the end of the move, and the end of the retracement level. For bullish trends, go from the low to the high, and for bearish trends, reverse the process. Once drawn, open the settings and adjust them for clarity. First, extend the lines to the right, making them easier to track as the price evolves. Next, remove unnecessary levels and focus only on the key ones: 100%, 161.8%, 200%, and 261.8%. Disable the background shading to keep your chart clean and visually focused. Also, turn off the display of price values to minimize distractions. Lastly, under the level section, switch to percent to display the extension levels as percentages. Let's now analyze the market structure, which is currently in a downtrend, and wait for a shock to signal a potential shift before considering buy opportunities. As you can see, I'm marking the lower highs, LH, and lower lows on the chart, along with the descending trend line to highlight the bearish momentum. I'm also identifying where a possible shock might occur. This is a critical area where the market could indicate a reversal or change in sentiment. Once the shock is confirmed, the next step is to draw the Fibonacci retracement tool to identify potential levels for trades, aligning with the new market structure. By following this method, we ensure a structured and disciplined approach to identifying high probability setups while waiting for confirmation of the trend shift. In the next step, after the shock confirms a possible shift from a downtrend to an uptrend, I'll use the Fibonacci retracement tool and draw it directly on the chart. This step is essential for identifying key levels to plan potential entries and exits. It's important to note that the retracement drawing needs to be adjusted as the chart evolves. After the shock, the price continues to move and creates a higher high, requiring us to recalibrate the retracement tool to reflect the new price structure. This adjustment ensures the retracement levels remain accurate and aligned with the latest market movement, helping us identify the most relevant zones for trade opportunities. By keeping the retracement updated, we maintain precision and adaptability, two essential elements for navigating changing market conditions effectively. Now, let's follow the strategy rules to execute Fibonacci retracement trades with precision. The key is to wait patiently for the price to close below the 61.8% retracement level. Once that happens, we look for the next candle to close above this level. When it does, that's our signal to open a buy position. To determine the target, we'll use the Fibonacci extension tool. Drawing it is simple. Connect the low to the high of the move and place the third point at the retracement level. This will reveal key extension levels, helping us identify the ideal target zones. For this strategy, the stop loss will be set at the 100% retracement level, providing a clear point for risk management, and the target will be the 100% level of the Fibonacci extension, offering a precise goal for the trade. As shown on the chart, this setup results in a winning trade with a risk-to-reward ratio of 1.83 to 1, making it an excellent opportunity. By following these steps and maintaining discipline, we ensure each trade is based on a solid structure and logic, maximizing the potential for consistent and profitable results. This trade highlights the power of combining Fibonacci tools with precise market structure analysis, giving us a clear edge in the market. Now, with the market clearly signaling a shift in direction, it's crucial to adjust our approach to align with the newly established bullish trend. Following the shock and BOS, which confirm a transition in market structure from bearish to bullish, our focus now shifts to identifying fresh buying opportunities. The first step in adapting to this change is to remove the previous bearish structure markings, such as LH and LL, as they are no longer relevant in the current context. Next, we'll redraw the market structure to reflect the new bullish trend by marking the highs, lows, higher highs, HH, and higher lows, HL. This update is essential for maintaining a clear and accurate understanding of the market's current direction, making it easier to identify potential setups and align with the trend. By updating the chart in this way, we ensure clarity and precision, allowing us to stay aligned with the bullish market and confidently look for the next high-probability trade opportunities. We then adjust the positioning of the Fibonacci retracement tool, starting it from the most recent higher low, HL, and continuing to update the high point as the price evolves. As observed, the price once again closes below the 61.8% retracement level, and then closes above it on the next candle, signaling another opportunity to enter a buy position. Now, an important point to note. After entering the trade, the price creates a lower low compared to the previous one. Although it doesn't hit our stop loss, which remains at the 100% retracement level, this requires us to adjust the Fibonacci extension. As a result, our target also needs to be updated, bringing the risk-to-reward ratio down from 1.9 to 1 to 1.72 to 1. Despite this adjustment, it still represents an excellent risk-to-reward trade. And just like before, this setup results in another winning trade, reinforcing the effectiveness of this strategy when executed with discipline and precision. Before we wrap this up, remember that this strategy is built on market structure and liquidity, with Fibonacci used only as a precision tool after direction is confirmed. This same logic continues in another video here on the channel, where we break down ICT's optimal trading zone and show how pullbacks are most likely to end for more precise entries. So, what is ICT's optimal trading zone and optimal trade entry? This is a structured trade entry framework built around price swings, Fibonacci retracements, and market structure. Its goal is to identify where a pullback is most likely to end, allowing traders to enter with precision instead of chasing price or reacting late. After a valid impulsive move breaks market structure, we apply the retracement tool to define the correction range. The optimal trading zone, located between the 61.8% and 78.6% levels, highlights areas where institutional participation is likely to return in the direction of the dominant trend. By combining market direction, price swings, and optimal entry placement with concepts such as fair value gaps and multi-time frame confirmation, this model creates a clear, repeatable framework for high-probability trade entries. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, technical analysis for day traders, trading psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.